So the chapter 8 in accounting for management, in dealing with the managerial cost concept and cost behavior analysis. So in order to understand the cost behavior analysis, we have to talk a little bit about the cost concepts. The cost concepts are driven by the management function or the manager's function in the company, which are related to the activity of planning, directing, controlling, and decision making. So every manager should ask himself a question: what costs are involved in making a product or providing the services? How the volume is going to change? Or if I change the volume, how the cost going to change? Or if I change the cost, how the volume is going to change? If I do the automation, is that going to help me for the cost? What will be the best control over the cost? To have the exceptional quality and at the same time to have a better cost for my products. Should a product or service be discontinued or should I keep going producing it? So for that reason, we're gonna start building some knowledge so we can make those analyses. Cost object. First, we have a cost object. Cost object is everything that we're gonna accumulate the cost to. The cost object can be for different industry, different things, but based on the, let's say we are McDonald's restaurant, hamburger will be one of the cost objects because that's the product that we sell into the customers. Haircut, if we are in the haircut salon and we're providing service for the haircut will be the cost object. Or tax return for the client is going to be cost object if we are tax return prepares. So once we know we have the cost object, we're going to have a cost. That will be our product cost. Product costs are those which help us to produce the product. The product cost, you're going to have a three component, and just a little bit later, we're going to go over the component of the product cost. But the other option for the cost will be the period cost. Now, how can we differentiate one versus the other? The product cost is the cost that's going to stay on the balance sheet as an inventory for the time being until it's sold as a cost of goods sold and go to the income statement. Where the period cost is any cost which is associated to support our production, but will be directly expensed. That will be the administration, that will be the selling of the selling expenses, that will be the marketing expenses, and that will be accounting cost for the company. That's a supporting cost, which will be period cost. That cost are incurred only and only because we have a business. But because we're running the business by selling the products, the products that we sell, they comes with a cost. That cost is separated from the period cost. In order to produce the product, we need three costs. One is the direct material, the second one is direct labor, and the third one is the manufacturing overhead. Now, those costs come exactly in the same disorder that you're seeing them. First comes direct material, second comes direct labor, third comes manufacturing overhead. Direct material is that's a direct cost, product cost, which comes in form of a raw material. Raw material is the material which has can be physically, directly, and easily associated with the production or with the product that we're producing. For that reason, they call direct materials. Example will be if we're in the baking company, that would be flour. If we're in the syrup, will be for the bottling of the soft drink. And the steel, if we're using automobiles, those will be the direct costs, direct materials. Direct labor will be any labor which is directly traced to our cost object, or the product that you're producing, or the services that we're providing. In the legal company, that will be the legal stuff. In the mechanics, that will be the if we're doing the that will be vehicle service company, that will be the mechanic that's working. And then we have one broad category cost, which is called manufacturing overhead. Manufacturing overhead is the indirect material which cannot easily be traced to the object, indirect labor which cannot easily be traced to the project, and any other costs which are related to production of our product but cannot easily be identified and easily to be traced to the cost object. Examples will be indirect material, of course, indirect labor, of course, and some depreciation or some amortization, some insurances, some utility expenses, security for the factory that we're using to produce the product. What else will be that? Some management, the manager who is directly responsible for the entire production, that will be indirect cost. Now the worker that's working directly on the production line, that will be direct material, because that can be easily traced to the every single product. But the manager, since the manager is to oversee the production, plus to prepare some other activities, that will be treated as a manufacturing overhead. So again, one is the indirect material. That will be the raw material cannot be easily traced to the product. Then we have indirect labor. That will be the employee which are in the production, but their labor cannot be easily traced to the product. That will be the again security, some cleaning people, maintenance, anything like that. That brings us to the first classification between the products. And first, we're going to have a prime cost, or the cost coming first, and then we're going to have a conversion cost. Now, what's the prime cost? Prime cost is the direct material and direct labor. Why those are prime? Because those are the first that come in. Prime means first. So, if you want to produce the product, we need a direct material first, and then we have somebody to work on the material in order to start producing the product. Those can be easily traced to the cost object. And since they're coming first, they call prime. Then we have a conversion cost. Conversion cost will be direct labor and manufacturing overhead. So in the formula, how this is going to be? Direct material plus direct labor is going to be prime cost, but direct labor plus manufacturing overhead is going to be conversion cost. What the conversion cost convert? Conversion cost convert direct material or raw material into the finished goods. So how can I convert a raw material into the finished goods? By applying direct labor and manufacturing overhead. And then we can start playing with the definitions of which one of the following is not element of manufacturing overhead. Anything which is not related directly to the product. That will not be related to the manufacturing overhead in this case. Let me see what you're saying. That will be A. Yes, that's the sales management salary. That's not going to be part. Now, the other one here will be, which of the following labor costs have been incurred by this company? Those are the costs that we incur. Of this amount, how much will be considered product cost? What we're going to have in the product cost? In the whole of product cost, we're going to have direct material, direct labor, and manufacturing overhead. Now, which one is considered direct material? The way I see it, I don't see any direct material, do you? Then we're going to have a direct labor, which we have direct labor. Then we're going to have indirect manufacturing overhead. And then we're going to have a period cost. Let's see what you're saying as an answer. So which cost we're going to include? We're going to include direct labor, definitely. We're going to include the indirect labor, definitely, plant. And once you say plant, the supervisor's salary will be part of it. And that's the only thing. So which one will be excluded? The sales commission and sales salaries will be excluded from our calculation. Now the product versus period cost, again, the product cost is the one that will be carried in the inventory for the time being, and later on is going to be expense once the product is sold. With the period cost, those will be directly expense. Period cost will be directly expense on the income statement as expenses. Those will be the sales marketing expenses, general administrative expenses. For the period cost, we're going to keep it again as inventory. That's why sometimes the product cost is also called inventoriable cost on the balance sheet. And once the product is sold, that's going to affect our cost of goods sold. Product cost, what we have to remember on the product cost, we have three components. We have direct material, we have direct labor, and we have manufacturing overhead. On the period cost, everything else, which is not direct material, direct labor, manufacturing overhead, directly will be expense as a period cost. Let's try this. Following costs can be incurred by this company. Of this amount, how much will be considered period cost now? We're not talking about the product cost, we're talking about the period cost. Direct material, that's product cost. Direct labor, product cost. Manufacturing overhead, product cost. Sales commission, period cost. Administrative salaries, period cost. So 4 plus 16 should give you 20, and the 20 will be your answer here. How the costs behave? Well, understanding how the cost behaves is going to help us to predict the cost. And that's going to help us to make decisions. For that reason, we need to understand how the costs behave. Now, the costs behave in different ways. In order to understand the cost, we have to understand the level of activity that we may have in our company. The level of activity is the one that sometimes drives the cost. What is the activity that drives the cost? Well, first one will be the sales in the retail. Kilometers driven if we have a trucking company. Room occupancy if we have the hotel. Dance classes if we have a dance studio. Number of the students if we have a educational company which provide education. So what that means is if we're driving more kilometers, cost gonna go up in the trucking company. If you drive less kilometers, cost gonna go down. If we have more room occupants on the hotel, that will drive more cost. If we have less rooms, we're gonna have less cost. So that level of activity is gonna differentiate how the cost gonna behave and how the income's gonna behave. So the changes in the level of the volume of activity that directly should correlate between the profit and the cost of the product. So to track this level of activities, we're gonna classify the cost into the three categories. We're gonna classify it as a cost which is related to the variable cost which is called fixed cost, and then we're gonna have a mixed cost. Now the question is, which one is what? Let's go with the variable cost. Variable cost is the cost that changes when the level of activity is changed. Now, what's the interesting with the variable cost? Per unit, that cost is always going to stay the same. But in total, that cost gonna start changing. What that means is simply, if you take a look at the cost of the coffee, McDonald's sells you now the coffee. I think they're still selling the small black coffee for $1. So what's the cost per unit? Cost per unit is $1. Now, what's gonna drive your cost? It's gonna be driven by the number of the coffee that you buy. If you buy zero coffee, the cost will be zero. If you buy one coffee, the cost will be $1. If you buy 10 coffees, the cost will be $10. So cost per unit for cost for the coffee is always stays the same. But in total, always gonna change based on the level of activity that you're using to buy coffee. Example, the variable cost will be direct material or direct labor, or sales commission, or gasoline for the airline company. Now again, the variable cost example here will be the manufactured tables. Contains every table. In order to produce the table, we have to use this camera. So once we use the camera, that increases the cost per table with $10. So if the 2,000 tables are made, how much we have to pay for the cameras? If the 10,000 tables are made, how much we have to pay for the cameras? Since the cost for the camera is $10, every time when you make a single one more table, the cost is gonna go with another $10. So if you produce 500 tables, costs for the camera will be 500 times 10. 10,000 tables, 10,000 times $10. 20,000 tables or 2,000 tables, 2,000 times 10. 20,000 tables, 20,000 times 10. And that's cost gonna keep going, keep going, keep going. Cost per the camera is not gonna change, always gonna be 10, but the total cost gonna start changing. So the variable cost usually behave as per unit, always stays the same, $10, but in total, it's gonna start climbing up. What that means is if we don't produce the tables, we don't have to input the camera costs will be zero. More tables we're producing, more variable costs for the cameras we're gonna have. Next thing that we have to see is the fixed cost. What is the fixed cost? Fixed cost is cost that stays the same now within the relevant range, regardless of the level of activity. For example, good example for the fixed cost for you will be the cost for SkyTrain. If you buy a monthly pass, cost per trip is not going to change. The cost per trip is not going to drive your cost because you already pay for the monthly pass. Insurance, once you pay the insurance, number of the event that's going to happen during that period, that's not going to change your cost. You already pay for it. So for that reason, you have to remember the fixed cost in total always going to stay the same. Now, how it's going to work per unit, let's see in a second. In the next slide, we're going to see, let's see this company leases on the premises for $10,000 per month. Total fixed cost obviously will be $10,000 for the all level of activities. If we produce one unit, how much will be the cost for one unit? Well, if we produce only one table and we're paying $10,000 for the facility to produce the table, the cost for that table will be $10,000. But if we produce 2,000 tables, then the cost per table is going to go $5. If we produce more tables and we go to the 10,000 tables, then the cost per table for the leasing the facility is going to be $1. So more we producing, we reducing the cost per unit. Now the total cost always going to stay $10, $10,000, but the cost per unit is going to start climbing down. In this case, going down, going down, going down. So what we have to remember is the fixed cost always stays the same. Fixed cost per unit always going down. How are we going to distinguish between the variable cost and the fixed cost? Well, again, variable costs are constant per unit, where the fixed costs are constant in total. Variable cost always increase in total, where the fixed cost per unit always goes down. That's how you should remember. Now, in order to predict the cost, we need to find some way that the costs behave, and then we can express that with formula. So the relationship between the variable cost and the changes of activity is not exactly the line, but is mostly curve linear. For the fixed cost is not linear. So what that means is the total variable costs behave something like this, where the fixed cost is for one level of activity starts to certain once you go with the relevant range, behave one way. When you jump to the next relevant range, become different. So what we have to do is in which relevant range the variable cost behave as a variable cost, true variable cost per unit stays the same in total increases, and the fixed cost is true, fixed cost stays the same. Once we find that area of our graph, then we're going to call it a relevant range. So within the relevant range, variable cost per unit stays the same, in total increases or moving based on the level of activity. For the fixed cost within the relevant range stays the same in total, but per unit goes down. That brings us to the next cost, which is the mixed cost. And mixed cost is going to have the component of the fixed cost and the variable cost. Now the fixed cost is always going to stay the same, but the variable cost will be the one who's going to start increasing the total costs. Total cost in that case will be the portion of the fixed cost plus the additional variable cost component that we may have later. On the product cost, how the product cost we're going to differentiate? No, obviously the fixed cost will be the factory rent, factory equipment depreciation, plant supervisor salary. Variable product cost will be direct material, direct labor, because those will be driven by the number of the products that we produce. And the mix can be the utility cost, which is always going to have the fixed component and the variable component. On the period cost, presidential salary or head office equipment depreciation, that will be example of the fixed cost. Variable cost will be the sales commission for the salespeople. More than selling, more commission we have to pay. Less than selling, less commission we have to pay. Mixed cost can be the head overhead utility cost again. Then we're going to start find a way to predict the cost. Again, why we need to know all about the cost? For only one reason. We to come up with the equation which is going to help us to predict the cost by applying to numbers to that equation. Once we do that, then we're going to have a little bit more understanding about the cost and we can predict the cost to help us. That we're going to do in class. In class, we're going to go with this high and low method. In the meantime, the high and low method, for the high and low method, we have, you have a video available, which is on the chapter, this chapter, chapter 8. So I strongly recommend you to watch the video and then we're going to discuss this one in class. I want to see what else we have here available besides the high and low method. Okay, I have to explain to you how the product cost is created, which we're gonna do in class again, and how to come up with the cost of goods sold. Again, there's available video, so if you want to watch it. If you don't, it's not the end of the world. I'm gonna discuss this one in class. And that's where I'm gonna stop today with this chapter. And in class on Thursday, we're gonna continue with building the knowledge on the costs.